Right. I think we're good to get started. So let's jump in. Well, so thank you so much, everyone, for joining us today for what I think is going to be a really interesting cross-cutting discussion on mineral wealth and electrification. Uh, the opportunity to bring this set of panelists together couldn't come at a better time. So we at the Jain Family Institute have been turning an increasing share of our attention to questions around mining, mineral wealth, and the energy transition. So the Jain Family Institute is a nonprofit applied research organization based in New York City, founded by Bobby Jain. We are just 10 years old, and we work on a variety of areas: guaranteed income, higher education finance, financing the energy transition, my own area, which is called social wealth, focused on supporting public asset owners. And we've got an increasing transversal focus on climate finance, and particularly on how we can bring our networks and resources to bear on sort of the most pressing questions around the energy transition. So it's really a great pleasure to be bringing this set of people together around a new initiative that my colleague Jonah Allen is leading here at the Jain Family Institute. So this work is titled Energy Transition Value Chains. And I'll leave it to Jonah to explain the project and sort of some of its principal goals, but I'll just mention that Jonah is a lead researcher here at the Jain Family Institute, where he is coordinating this new energy transition value chains initiative. He has a BS in Environmental Studies and certificate in Technology Business Management from UC Santa Barbara, and is currently finishing his PhD at the Colorado School of Mines. He has direct experience also in renewable energy, project management, and groundwater management, and really brings a wealth of experience and a kind of remarkably sharp intelligence to this work. So with that being said, it's my great pleasure to hand it off to Jonah to lead us into the event.
Thanks, Paul, for the great introduction and background on the organization. Yes, Paul mentioned Jonah, and I lead the energy transition value chains work here at the Jain Family Institute. And we're really excited for our expert panel discussion today. And just before we dive into that, I'm going to kick us off with a brief presentation touching on some of the themes in our recently published series, Mineral Wealth and Electrification, a Producer Country Perspective. I encourage you to explore this series, which includes the report, this interactive map, which we've created, as well as the technical appendix describing the map. And the map is an illustrative comparison of the relative scale of opportunity to mineral producing countries around the energy transition now through 2030, and also includes high-level analysis of royalty rates globally to include some insight on varying policy environments around value capture in this opportunity. I'll mention that royalties are just one part of the strategy, many strategies available to retain value from mining for energy transition, as well as manage and invest those revenues. I'm sure we'll talk about some of those today. And we are excited to dive into this in the next stage of our work, more into this, as well as into more detail in royalties in country-specific contexts and other strategies, as there can be important country-specific considerations. So again, encourage you to explore the series and stay tuned for our work in 2025. And before we jump to the discussion, I also want to frame what we mean by producer country perspective, which you will have read or heard us say many times by now. And I'll start with a familiar story, which is that the technology is necessary to decarbonize our electricity generation, transport that electricity, and use it to power sustainable transportation, as well as store it across the grid, greatly expand the scope and scale of mineral demand. And coupled with global development, in the long term, we can expect mineral demand growth to be unprecedented. And these minerals are distributed differently than the fossil fuels, which have powered the last century or so of economic growth. And this presents new challenges and opportunities to the countries that will both, be producing and consuming these materials. Particularly for those countries that are situated as global leaders in mineral production, there's a positive challenge faced to turn this one-time extraction of these materials into durable solutions for long-term investment growth and prosperity. However, the discussion thus far has really focused on the needs of consumer countries, which utilize these materials to manufacture higher value products. And from this perspective, transition critical minerals are, the consumers are really focused on supply chain resilience, often from a national security angle. Centering the conversation around a producer country perspective, on the other hand, should be more focused on the economic opportunities that the extraction of these transition critical minerals may afford. And from this perspective, transition critical minerals are far from equal, both compared to fossil fuels and compared to one another, as you can see in the chart. And more broadly, the total value capture picture for mining for the energy transition is very different from extraction for fossil fuels. For one, markets are much smaller. The global trade value for fossil fuel products in 2022 was nearly 4 trillion. And for all of these materials combined, about 275 billion, so less than 10% in global trade value. And additionally, these fossil fuels are kind of existing in relatively short supply chains. For example, 94% of oil and gas is burned for energy consumption. In contrast, transition critical minerals are inputs to long and complex supply chains to manufacture products that will last 10 to 30 years with potential for end-of-life recycling and reuse. Take, for example, the lithium-ion battery value chain in 2030, according to estimates from the World Economic Forum and McKinsey. Lithium, nickel, and cobalt mining together are estimated to represent only 3% of the gross sales value, the revenue potential, across the entire supply chain. The kicker is that there's potential for producer countries to retain sort of a larger slice of the pie by moving downstream in the extraction and manufacturing of energy transition technologies, and also that focusing only on mining alone would be a missed opportunity. So with that, I'm going to close with just a few questions, sort of framing a producer country perspective, and questions that I'm sure we'll get into today during the webinar. What is the scale of opportunity for mineral producing countries globally? What strategies are available to producer countries to generate lasting wealth from the mining sector? And what opportunities does the energy transition present for research-rich countries to pursue development objectives? And with that, I'm going to introduce our panelists. We really have a broad group of perspectives here, and I'm very excited for the discussion. So pay attention to the introductions, and I'm sure you will be as well. The discussion will be moderated by Ellie Gomez-Callas, who is a Metals and Mining Associate at Bloomberg New Energy Finance. Her research covers battery and metal markets, global critical mineral policy, and energy transition metal supply chains. Prior to her role at Bloomberg New Energy Finance, Ellie spent her time as a research scientist with RFC Power, an energy storage startup, before joining the UK government. At the Department of Business, Energy and Industrial Strategy, she worked in oil and gas policy and energy innovation funding. Ellie holds a BS in Natural Sciences from the University of Nottingham and a Master's of Science in Green Chemistry from Imperial College London. Dr. Ian Lang is the Viola Vestal Coulter Chair of Mineral Economics at the Colorado School of Mines. Additionally, Ian serves as the chair of the U.S. Commodities Futures Trading Commission's Role of Metals Markets in the Transitional Energy Subcommittee. He is also a member of the Colorado Governor's Revenue Estimating Advisory Committee. Previously, Ian served as a senior economist for energy at the Council of Economic Advisors for both the Trump-invited administrations, as well as spending time at the U.S. Environmental Protection Agency and the U.S. Department of Energy. Thomas Lissou leads the International Institute for Sustainable Development's work on tax and extractive industries. He manages the Global Mining Tax Initiative, an offering of the Intergovernmental Forum on Mining, Minerals, Metals, and Sustainable Development. He is an economist with over 15 years of global experience analyzing, designing, and implementing reforms in public finance, tax policy, and mining sector governance. He represents IGF on the UN Subcommittee for Extractive Industries Taxation and has contributed to various publications on natural resource governance and tax policy. Thomas holds a master's degree from the Paris School of Economics and a master's in business administration from HSC Paris. Pedro Oliveira de Sena Batista works at the Minas Gerais State Secretariat for Economic Development as Superintendent of Mining, Energy, and Logistics Policy. Previously, he worked at the same secretariat as Energy Director and Energy Advisor. Pedro has a degree in biology, economics, as well as a master's degree in administration from the Federal University of Minas Gerais. For those unfamiliar, Minas Gerais has a long history of industrial mining dating back to the 18th century. Though the industry is currently dominated by iron production, developing lithium operations and deposits of nickel, cobalt, and copper offer potential. Tem Tomurbat is the co-founder and managing partner of Nomadic Venture Partners, where he focuses on fund strategy, fundraising, portfolio construction, valuation, and financial analysis. Nomadic Venture Partners is an early-stage venture capital firm investing in digital and light hardware solutions decarbonizing incumbent industries such as mining. Prior to co-founding NVP, Tem was an investment professional at Resource Capital Funds. Before that, Tem worked for Newmont Mining Corporation as a mining engineer and then project engineer. Tem also co-founded MNG Summit, a nonprofit organization supporting Mongolian students and early career professionals. For a period, Tem served as board member and treasurer of the Colorado chapter for the Society of Mining, Metallurgy, and Exploration, as well as board member of the Ulaanbaatar Denver Committee for the Denver Sister Cities. Tem has a BS in mining engineering from the Colorado School of Mines. Daniel Abdo is the Director of International Relations and Business Development at Sigma Lithium. Sigma Lithium operates a fully integrated hard rock lithium mining and industrial beneficiation complex in Minas Gerais. He was previously a senior advisor for the turnaround and transformation in corporate finance and strategy practice areas of the Boston Consulting Group. Prior to that, he was head of investments of RK Partners and an investment officer at Angora Infra. Daniel also held investment banking positions at Goldman Sachs in Sao Paulo and with JP Morgan in London. He holds an MBA from the Wharton School of the University of Pennsylvania and a BS in electrical engineering from Tufts University. All right, and with that, let's kick off the discussion. So I will pass it to you, Ellie. Thank you.
Thank you, Jonah, and thank you, Paul, as well for the introduction.
May I actually just jump in with the quickest note to say that I have confirmed our Q&A function is working. So throughout the event, if anyone would like to pose a question, which Ellie can address later, you can use the Q&A function. That's it for me.
Perfect. Yeah, thank you both for the introduction, but also thank you for the time that you've put into your research that we're going to be discussing here today. Access to such in-depth and specific data and tools like that which JFI provides is extremely important. It plays not only a key role for governments, industry, and financials to understand risk, opportunity, and competitiveness across the mining value chain, but this is happening at a time where the sector is increasingly in the spotlight. And I can speak on behalf of everyone here today that we're looking forward to see what is coming next in the series. Next, I want to thank our panelists before we get into discussion for their time here today. Over the next hour or so, we'll be discussing how producing countries can maximize their mineral wealth in the context of the energy transition, but also changing market conditions. The plan is to split this topic into three key themes. So we'll be starting with critical minerals fundamentals, where we will dig deeper into the current supply and demand dynamics across key metal markets and the impacts of such dynamics on long-term sentiment. Next, we will explore realizing mineral wealth in consumer countries, and more specifically, some of the mechanisms in which governments can best harness a country's critical minerals potential, and using Brazil as a particular example to discuss this. And finally, we'll end on understanding the role of private investors across the mining value chain. Financing is essential for the sector to progress, and we'll be looking closer at how this process occurs from an investor perspective. But before we get started, I just want to remind you what Paul said. We've got lots of exciting chat to come. So thank you all for being here. And just a reminder that please put any questions in the chat, in the Q&A function, and we will try our hardest to get to those at the end. Okay, so let's get started now. So BNF's most recent transition metals outlook estimated that demand for energy transition metals, that includes things like lithium, cobalt, nickel, graphite, some of the things that are touched upon in JFI's research, demand for all these metals between 2023 and 2050 will reach almost 6 billion tons on a pathway to net zero. Yet at the same time, we're seeing current conditions across some of these markets, particularly those for battery metals, not looking very rosy. So I wanted to start with you, Ian, and I was wondering if you could please provide some context into why the near-term outlook for various critical minerals looks unfavorable at the moment, and explain how these shorter-term dynamics can coexist with these long-term growth forecasts.
Yes, thank you, Ellie, and thank you for having me here. Right, and I think this point was even further on display this morning, where I think Fast Markets announced that basically copper demand over the next year is looking lighter than expected, or there's bearish signals in copper, which is another mineral that everyone is thinking will have demand that increases, we'll say, exponentially, or have a lot of demand coming up. And so that obviously makes it difficult for companies to decide what it is they should do. What I kind of see happening is, people seem to be betting on a couple, right? So like lithium and copper seem like something that, yes, there might be short-term, ebbs and flows, but really the demand is going up. And so people are putting actual investment into that, or there will be sort of joint ventures being made. One of the most, commonly talked about here in the United States is Thacker Pass with GM. And so that's really seems to be where people think they can manage the short-term up and downs. It's a lot harder with the other minerals just because their markets are smaller. They're really tied to maybe a specific kind of battery chemistry. And so then their demands, even though projected to increase, we'll say that projection has a lot more error bounds on it. And so it'll be interesting to see as the future moves forward, some of that uncertainty gets out of the way, and do some things, we'll say, no longer become critical.
Mm. So you mentioned these ebbs and flows that happened in terms of supply demand, and is there a general time period in which different metals can get out this sort of like periods of ebbs or trough periods?
Yeah, I mean, I think certainly you see the market sort of trying to find its footing a little bit, right? We had in 2022 highs for most everything. Now maybe in 2024 we have lows for most everything. And so I think when some of this battery chemistry, we'll say technology innovation, maybe I don't know if the word is settles down, but sort of gets to a place where we're like, all right, these are the two clear winners. We're going to see maybe things harden, or basically markets really sort of focus in on what it is that people will be needing, and maybe some of these projections of long-term demand may be coming closer to focus with short-term demand. There are the other minerals, obviously, like rare earths, that are much smaller markets to begin with. Those are going to be much harder to suss out what's exactly happening, just not as much good information out there, say traded contracts and things like that people can look to the futures markets or look to areas and say, oh, okay, this is what what we really think is going to be happening.
Yeah, and you raise a good point there. I think when it comes to having the right information to try and avoid the sort of bad sides of these commodity cycles. I just wanted to open the question up to the floor in terms of, do we know any strategies that have been deployed by governments or private sector to help manage this uncertainty when it comes to the short term and the long term of critical minerals? Thomas, yeah.
Thanks. I don't think I have an answer. Maybe another question to your question for everyone. It's on the trade agreements. So we see some governments getting into trade agreements for critical minerals with other governments. And I'm wondering, is that a way to provide this kind of long-term security of demand that maybe some investors or governments need to invest or to support investments in their countries? Or do we think they are insufficient, or they should take a different form?
I know that from oh no, Ian, you go ahead.
Oh, I was just going to say, yeah, like this uncertainty seems really hard to navigate. I mean, general mining is aware of uncertainty, and mining companies have figured out ways to deal with some of that uncertainty. I mean, in the renewable energy sector or in other, sectors, they've had things like contract for differences as ways to, reduce that uncertainty. There's been discussion, we'll say, in OECD countries about something like that. It's harder, at least from my opinion, it's harder to see something like that really with large markets. You're going to put a whole bunch of money behind that potentially, but smaller markets, I mean, in some sense, it's almost crazy that governments haven't done that. So say from a defense industry, some of these byproducts that are of interest to governments, like, you can relatively cheaply put in some sort of either, sign an offtake agreement or do some sort of contract for differences to top up so that a company can make an investment and procure some of the metals that they'll need for, say, for defense industries, where these markets are extremely small. The amount of money we're talking about is kind of rounding error in many government budgets.
Yeah, I think you both raised good points in terms of we have to understand what mechanisms already exist and try and leverage them to the wider goal. Because I know that a good example of that in terms of permitting is that there's been some great movements in other renewable energy sectors in terms of permitting improvements and trying to get some certainty, and that could be replicated within the metals and mining sector. Not necessarily easily, but it could be an idea for governments and nations to look at to help drive these uncertainties and keep them at bay. But yeah, all this is coming at a time where countries are trying to realize their mineral worth. It's quite crazy. It's only within the past few years that people are putting sort of the words critical minerals and energy transition together. Critical minerals are needed in essentially all sectors, from hydrogen to wind to EVs. So realizing this opportunity of mineral wealth is becoming more and more valuable. And I was wondering, Pedro, if you could please comment on this perspective from a Minas Gerais perspective. In terms of where do you see opportunities for Minas Gerais to invest in critical minerals exploration, production, and refining? And are there any challenges that exist to realizing this opportunity?
Thank you for your question. Just give you some context about the kind of matter here that we are talking about. In our opinion, it's impossible to talk about energy transition and renewable energy without referring to the mineral sector production chain, the growing of demand for critical and strategic minerals is a result of a global energy transition that we all are living right now, and the growing of this demand, we seek to reduce the dependence on fossil fuels. In this scenario, Minas Gerais has a great potential for reserves of these minerals. We stand here mainly in the exploration of lithium, mainly graphite and niobium. So if we look closely at the production chain, we see that many of the critical and or strategic minerals are crucial raw materials for renewable energy, and they can be used on a large scale. So you're saying right now about EVs, about hydrogen, and we know that electrolyzers for producing green hydrogen depends heavily on critical and strategic minerals. We also know that solar panels depend on these minerals and so on. This positions Minas Gerais as an indispensable player at national and global level, given, for example, that we have the largest national reserves of lithium and graphite in Brazil. In addition, we have the largest reserve of niobium in the world, in our territory. These are examples that demonstrate the importance of Minas Gerais in the context of renewable energy. That is, from mining to the production of this type of energy, Minas Gerais potential becomes very, very clear. So we also have challenges. What kind of challenges we have here to realize the opportunity? Despite Minas Gerais leading role in mining and energy transition in Brazil and South America, it's necessary to constantly work in improving the state infrastructure with focus on attracting investments that transform the current social reality. And improve infrastructure, it's possible to attract more and more investment that the strategic minerals and renewable energy sectors, in addition to making companies in other production chains see that the state has the necessary conditions for projects to become viable. And considering the necessary conditions, there is also a constant need to act to simplify process with focus on improving the business environment. This refers to the modernization of the state environment legislation, modernization of the state tax legislation, and the reduction of bureaucracy, and aiming to convey the image that the state is a partner of the investor and provide enterprise. In this sense, the state government acts by offering all the support for attracting enterprise and also monitor its licensing, installation, and operation process, ensuring that the success of the business will be guaranteed. And we want to convey the message that Minas Gerais is the best place in Brazil to invest and live. So you have a great potential and also have a lot of challenges, but we are moving forward. We have a good perspective for the next future.
Elliot, I believe you're muted.
I'm not hearing Ellie.
Literally moderator 101 and I failed. Sorry, I was just saying thank you so much for that response, Pedro, in terms of you mentioned infrastructure, you mentioned the need for simplified process and the lack of red tape. And I was wondering if there is anywhere else in Brazil or any other countries that that are producer countries of minerals, not just Pedro, but again, to the whole panel, that you think have been able to achieve this or make some improvements in these areas over the past few years? Because I feel like we've seen a lot of producer countries trying to move forward in these steps, and I guess we've seen a lot more policy acts coming place, not just on national levels but also sub-national levels. Perhaps we can bring the question back specifically to Minas Gerais in terms of the region has, Pedro, the region has a long experience with iron ore production, which has been profitable for certain companies. But again, as it hasn't necessarily translated to local development and downstream investments. So what lessons can be learned moving forward to look at other critical minerals? What specific measures do you hope to take as a region to help address these forthcomings from iron ore production?
Thank you, Ali, for your question. For us, challenges for the futures do exist, like I said before, but they can be overcome. And this is because the search for modernization of the state operations with focus on attracting investments is already reality, like I said. In addition, following government guidelines, we are creating an environment that is increasingly conducive to attract investment in new business, since the disbureaucratization of the state legislation makes it easier for the productive sector to be the main gear in the economic development process. By also working with the society, and I think it's a very important thing here, working with society, promoting constant and direct dialogue. It's one very, very, very important thing here for us. Minas Gerais reconciles the interests of social groups with different positions to enable everyone to reap the benefits of responsible economic development in the medium and long term. So we have some conflicts that it's a challenge as well, but we are moving forward. Also, the government envisions responsible economic development that is a sustainable basis. In addition, we advise the generation of jobs with qualified labor, improvements to our infrastructure, and decarbonize economy with the production of products with higher added value and resulting from results of investments in science, technology, and innovation. So here we understand that Minas Gerais will remain the forefront of the Brazilian transition, being the state with provide an example of and success stories for Latin America and the world. But all of this that I'm saying right here is because of our previous experience with iron ore. So initiatives such as the State Mining Plan and the Lithium Valley Brazil projects and the wide dissemination of the state protection in relation to critical minerals end up involving not only the companies and the government, but also the science, technology, research, and the innovation institution. So we think that all our mining past, let's say like this, all our mining past, it's very important for us that we can say that we have this kind of past, we have this kind of challenge, so let's do something different to achieve our goals with lithium, niobium, and graphite, and rare earths, and everything that we have the potential here.
Thank you. Do you have something to add, Ian?
Yeah, I was going to say, in addition to the issues Pedro brought up, there's obviously the idea that both the mine and the refining facility sort of want stable, a stable supply of the product, right? So the mine's got to provide the concentrate to the refining facility. And of course, what size is the mine? Does that size of the mine fit well with the size of the refinery that might be profitable or best to be built? And so there can be a bit of a chicken and egg problem that, maybe, to some extent, either government solve or somehow has to be figured out such that, a steady supply of the concentrate from the mine gets to gets to the refinery. You can't sort of have, oh, sorry, I'm not sending you something this month, or, oh, you just need to stop and start. It's generally not how both of these facilities run, we'll say profitably or run well. And so, yeah, there can be just sort of this lining up, those two sides that can make it difficult for a given, we'll say, entity, whether it be state or national, to delve into the benefits that go further downstream from the refining and processing.
So we need, in order to realize opportunity across the whole value chain, you need sort of like a reliable, secure, and also de-risked sort of production that can withstand various sort of like environments. And I guess that's also from a country sense, but also a technical sense as well, that the labor and skill required at each of the mine and refinery is matched or can have what it needs to operate successfully. I think that's a good point, but that brings us quite nicely onto Daniel, in terms of Pedro and Ian have both spoken a bit about Brazil's opportunities and what is needed to help realize a country's mineral wealth. But I was wondering if you could give us an insight from an industry perspective and tell us a bit about Sigma's story and why Brazil has recently become such an important jurisdiction for the lithium industry.
Absolutely. Thanks, Ellie. So Sigma today is the fifth largest lithium industrial complex worldwide. It's a story that's been 12 years in the making. Our operations are in the Vale do Jequitinhonha in the state of Minas Gerais, which is one of the poorest regions in the country, consequently worldwide. I'm also a partner at A10 Invest, which is an impact fund, and we invested in Sigma at a time that was very challenging in Brazil and worldwide for the industry. This was 2015 when the first tailing dams disaster happened. And, our focus back then was, to set out and show to the world that it was possible to make a sustainable mining operations, both from an environmental and a social perspective. So back in 2018, so the fund came in 2015 as an investor. 2018, we needed further capital to continue our growth plans, but there was no capital in Brazil for lithium at that time. So we went to jurisdictions that were more junior mining friendly, and we ended up listing on the Toronto Stock Exchange. And later in 2021, we moved to NASDAQ in order to reach a broader investor base. So we finally began production last year of our product, which we call Quintuple Zero Green Lithium. And the reason for that is, one, we have zero tailing dams in our operation. We're the first lithium operations globally that does not use tailing dams because we dry stack our tailings. We use zero drinking water because we source water from a river that's 5 kilometers away from our operations. And as Pedro pointed out, given the lack of infrastructure in this part of the state, there is no sanitation infrastructure, so the water in this river is improper even for industrial use. So we built a water treatment facility right at the entrance of our plant where we treat our water and recirculate that in the entire circuit. We also use zero dirty power, which is one of the great advantages of operating in Brazil. Our energy is supplied from renewable sources, mainly hydro, solar, and wind. We use zero hazardous chemicals in our plant, and we are zero carbon, as our carbon footprint is mainly in our extraction operations, in the diesel used in our trucks, and the explosive used to dismount the mines. Our plant is a dense media separation plant, which is a technology that we borrowed from the diamond industry in order to separate the spodumene ore from the mined ore. And we recently received funding from the Brazilian Development Bank, something to the order of $90 million, in order to build our phase 2, which will double our current capacity. But all of this that we've achieved so far would not have been possible without the support of the communities we are in. So our operations are between 2 municipalities, one with a population of 34,000, the other with about 27,000. And, our mindset from a company perspective was also always, what opportunities can we create for these people to grow alongside with us? So most of our social programs are aimed at that. So, one of the first things we identified when we started operations was that a lot of the people left the region for lack of jobs. So we started a program through radio, through the internet, to repatriate these people back to the region so they can be together with their families and with a dignified job and lifestyle. Then we also created a microcredit program for women entrepreneurs in the region, and a program for the the farmers in the region. It's a very dry region that only gets about 4 months of rainfall a year. So we create these rainwater capture systems for them, and this has all been very successful. And that has been fundamental for our operations to move forward. And then just talking about Brazil in general, what are the advantages of the Brazil zip code? As Pedro said, we have an abundance of natural resources in the country. As I already mentioned, 85% of our energy grid is renewable, 50% of it being from hydro sources, the rest from wind and solar. We have a very strong legacy in the mining sector, so we have the human talent as well as strong legislation in place. And I guess given the current scenario we are in, very importantly, we are a neutral country. So we are important trading partners with the US, with Europe, and China.
Perfect. It's great to hear some of the sustainable practices that are happening at Sigma, because there's quite a high negative perception in terms of environment when it comes to mining. But I think it's important that that perception is spoken about in terms of improvement and realize that it's not a blanket measure that goes across the whole industry. Because what have been your biggest drivers looking forward in terms of sustainability and in terms of sustainability?
So again, making sure that our neighbors are taken care of. I mean, that's the number one driver. So just an example of something we did in our operations. So we're currently using 40-ton trucks to move ore within from mine to our processing plant. We could be using 100-ton trucks, but those are a lot harder to train people. So by using the 40-ton trucks, we can train more people more easily and provide more jobs in the region. So, that's what we really have in mind. I think in terms of the environmental aspect of our operations, we have that pretty well covered. Now it's just a matter of scaling our operations. But I think, we can continuously help the communities around us, lift the people in those communities.
Perfect, thank you. So we've touched a bit upon how Brazil, what opportunities Brazil has from a mineral wealth perspective. Now I want to go to sort of if this is captured, what does that look like, and how can this be captured? So I want to turn to you, Thomas and Tem. Starting with Thomas, basically, I would like to, if you could please explain some of the ways in which governments can get the key sources of public revenues from the mining sector, and what are some of the vulnerabilities to retaining and investing these revenues?
Thanks a lot. Really great question. And so I work for the IGF Secretariat, the Secretariat of the Intergovernmental Forum on Mining, Minerals, Metals, and Sustainable Development. So we have 85 member countries now, spread across the world, most of the Americas, most of Africa, a lot of countries in Asia and Europe. And so this is a question that comes, very often. So we try to provide support to countries on a range of issues, and I work specifically on tax and financial benefit sharing. And so what we see, the mining sector can be an important contributor to government budgets. And because it's a non-renewable resource, it is especially important that minerals provide direct financial benefits to host government. There is no second chance. If you want to extract them, that's it. And especially when market conditions create location-specific rents, and so there's a substantial rent being created on these minerals that needs to be shared with host governments and host countries. So in terms of, there's a million ways, but maybe to simplify a bit, typically the way governments capture financial value directly from the minerals is through royalties and corporate income taxes, the typical royalty tax fiscal regime. There are some weaknesses though. So royalties, they're based typically on value of production. They're not very responsive to profitability, so they're not very good at capturing mining rents when there are rents. And corporate income taxes, they're supposed to be much higher than if you model a mining project and you see at the breakdown of revenue collected by governments. Typically, corporate income taxes represent 2 to 3 times what royalties should provide, and you do see that in aggregate if you look at the data shared by members of the International Council on Mining and Metals. They publish annually their contributions to governments in terms of royalties and income tax. You do see that income taxes are on average 2 to 3 times what royalties are, how much royalties are paid. But the thing is, in some developing countries in particular, where capacity is quite low in tax administrations, you don't see that. You see that countries are quite disappointed with how much corporate income taxes they're able to collect. You do see some issues around base erosion and profit shifting, with a million ways for companies to minimize their tax base domestically. And you do see also poorly designed tax incentives by countries themselves, just not using the right tax incentives for the right projects, and then losing out a lot of revenue as a result. That was probably not necessary. So because of those weaknesses, and also for political reasons, you do see also countries exploring a lot of other ways to capture revenue from mining projects. So royalties themselves, there's a ton of variations around royalties. You have profit-based royalties, you have variable rate royalties, with where the rates can vary based on prices or other conditions. In addition to profit taxes, you have a number of resource rent taxes. They also have different forms. They can be called windfall profit taxes, super profit taxes, and other ways. And they typically try to collect part of the mining rent above and beyond what income tax would be able to do. And then you do see a lot of countries using state participation, either directly with a state-owned company or with passive participation in mining projects, sometimes even production sharing contracts as other contractual approaches to capture more revenue from projects. That's more common in oil and gas, but you do see it in some mining countries. And you do see a lot of countries now revisiting their mining policies because of demand for some critical minerals, and exploring whether those options are available to them. So yeah, in a nutshell, that's it. We can go into more detail if people are interested.
I have an immediate question, actually. So can these same mechanisms be used across the entire mining value chain? And say, for example, actually, that's the first question. Can these be used across the whole mining value chain?
It's a good question, and the response is no. I mean, this is very specific. A lot of these mechanisms are specific to the upstream, the extraction. This is where the resource is taken out of the ground. It's that most countries, minerals are publicly owned resources, and so they have, extracting them represent a loss of assets for the state, and it has to be compensated. So that justifies a specific type of fiscal regime, and justifies governments maximizing their take from mining itself. If you go further down the value chain, then you do want to incentivize investments and production and manufacturing and industrialization. And so that's where you have to be a lot more careful with how you set your fiscal regime. I mean, typically they would be subject to the common generally applicable tax law. But then a lot of countries are thinking carefully about the right package for their downstream beneficiation activities, to be able to create the right conditions for companies to invest. And as we've heard from Brazil, I think taxes are a small part usually of the investment decision. Companies want the right conditions in terms of energy, infrastructure, labor force, regulation, rule of law, but they do care also like how much the state will collect from benefits that they make at the end of the day.
Okay, and if we go back to just the upstream, thinking about sort of the extraction operations, what are some of the key strategies that some producers have used to help increase the certainty in public revenues? Like, how have we seen some of these regimes change to help strengthen what producing countries get?
Yeah, it's a good question. So you do see some innovations of mining fiscal regimes, but what's important is for countries to think with a long-term perspective. What you do see too often is countries reacting as the market changes and the prices of the minerals rise and fall. They start to change the fiscal regime to maybe to capture more, or like to reduce taxes if they feel they're too high at a certain point. But then 3 years later, they increase them again. That's not the right types of policy that investors would be looking at, and it doesn't create certainty for the country either in terms of its revenue needs. So it's important to take a long-term view, and there are two aspects to it. One is on the fiscal regime design. It's important to really think about your specific minerals as a country, how much you're likely to, what's your place competitively in the market, how much interest there is from the rest of the world, and then look at specific assets that you have, see how long they can run, what's the right conditions to allow commercial viability and investment, but also how much the state can reasonably collect out of the future profits. So having some kind of advanced modeling and analyzing the benefits, discussing with the private sector what are feasible fiscal regimes. And the second part is on administration. A lot of developing countries in particular, you see that there are issues around collecting, even when the fiscal regime is fairly designed, there are issues around collecting the right amount. And so they need to invest in monitoring the quantity and quality of mineral extracted to better understand what exactly is being extracted and what's the actual value. Follow and understand the markets that these minerals are part of. And for tax administrations in particular, there's a big need of sector expertise and transfer pricing capabilities, better IT systems as well, to be able to implement international tax rules that are quite complex and enforce the income taxes and other taxes that are applied on very complex industries. So those can help improve certainty for governments.
So that's really clear. So essentially, countries have to take a unique approach, but they also have to focus on the long-term perspective, collaboration within public-private sectors, but also focus on the quality control and sort of efficiency of the regime in place. That was super clear. Thank you, Thomas.
Okay.
And that sort of brings us now to you, Tem. It'd be useful if you could please give us a bit of context into what Nomadic Venture Partners does and explain a bit what of the role of financial actors in broadening investors within the mining sector.
Yeah, thank you. So what we do is we are a seed stage climate tech fund, really focused on decarbonizing these incumbent heavy industries, right? Specifically metals and mining, and that's one of the primary focus sectors we have. And we developed this thesis because, as many of you discussed today, right, there's this incredible demand story that we are constantly talking about, right? By 2050, right, lithium demand is going to go up by 42x and so on and so on. But if you analyze whether the mining industry is actually ready to deliver on that demand from a supply side, there are a number of different challenges, both technical, both investment. Also, there are these geopolitical complexities. And what we realize is that in order to really make this energy transition happen, you have to somehow increase the supply of these critical minerals relatively quickly and respond to these price dynamics. Because as many of you know, right, it takes forever. It takes 17, 20 years to bring new supply online. So how do we quickly respond? That was a big question, and the one of the many answers, in our view, probably the right answer is to leverage innovation and technology to be able to help the existing producers provide additional supply, right? And hopefully do it in a very, very sustainable manner, like the one that Daniel talked about through not producing any emissions or using potable water and so on. So that's what we do. So we're investing in technologies across the mining value chain that either helps mining companies make new discoveries or help them mine better, right? Optimize their processes. And once the ore is mined, right, can we hopefully use 100% renewable resources to power and power the comminution steps, right? This is the mineral processing steps. And once you have a product, or how can we think about refining them into products that are much, much more sustainable, all while doing that, do it in partnership with local communities. And I think the big part that often slows down projects from getting permitted, and this is going back to my days at RCF when we were investing in mining projects and in constructing these mines, right? Oftentimes the challenges with getting environmental and mining permits is not having enough buy-in. And when you really try to understand why that's the case, it's either not sharing the economics, right? I mean, Thomas touched on how private sector can partner with the public sector to be able to distribute more of the economics, but more so it's really right getting them involved and making sure local communities truly understand the implications, the risks, and the challenges, and hopefully, right, coming up with innovative ways to reduce any of the negative impacts that the metals and mining space have. Now, from our perspective, we think we can really help the industry through innovation and technologies to increase supply. Now, but on top of that, right, the supply and demand in terms of short-term sort of pricing movements that does affect many producers, right, making decisions on whether to develop a certain project or not. So I think from the private sector's perspective, the more that the public can do or the governments can do to provide, right, very consistent certainty or consistent, right, taxes, royalties, whatever it may be, right? Doesn't matter what the number is, as long as these policies are there and won't change for a while. That'll add this additional layer of certainty that investors then can say, okay, now we're interested in putting additional capital at risk to be able to investigate these new and emerging technologies that could help the operators, right, and the likes of Sigma Lithium to be able to, right, keep doing what they're doing. So hopefully, right, private investors are looking and saying, okay, what are the government policies? What are the regulations? What are the partnerships that are being formed that can help private investors to say, okay, we feel like a lot of the big risks are somewhat mitigated, or at least have some certainty on what they're going to be, so that we can continuously deploy and bring forward the supply and help the world, right, meet this demand story. So I'll pause there. I know I've touched on a number of different topics.
I think the government certainty point is very important, and is particularly at the forefront of lots of people's minds at the moment, especially with US elections. We saw that, for example, lots of incentives that could now be repealed in the next administration. So it sort of could reverse some of the good progress that countries have made. But then not all producing countries, not the US is producing countries, but to move it back to producing countries, not all governments necessarily have the same fiscal capacity to offer incentives to for mining projects or refining projects. So what are other mechanisms that could be used to sort of incentivize industry to come to a certain region and invest in a certain region that aren't fiscal?
Yeah, that's a great question. And mining is very cyclical, right? And we go through these commodity super cycles every 6 or 7 years, and it's really hard to plan. But I think many mining companies have learned to plan through multiple cycles, right? If you look at, for instance, Sigma Lithium's, right, price projections and their costs that they're using in their models. I don't know what they are, but I can tell you that they are using a very conservative price deck, right? And that's by design, because they know that if they have an operation that it is that's going to have a very small margin, right? They're going to be feeling a lot of the financial distress during low price environments that we are in right now. But how do we further enhance that and provide that certainty to investors is to have policies that not necessarily put out a lot of private or public capital outlay, right? I think this current administration, I mean, in the US, have deployed a lot of, I'm talking billions of dollars, right, financing or providing loans to companies that are trying to prop up the mining sector. But when you're in a very low price environment, a lot of these projects are all of a sudden being put on care and maintenance, right? So the governments are spending a lot of money, and then only to tie a lot of that capital and get it stuck, right? Yeah, maybe the US could afford to do that, but many other countries, cannot do that. So what could they do? I think one of the examples that I think people have been talking about, for the past, number of years is providing some kind of a pricing, guarantee or pricing, like a price floor, right? Or maybe even an insurance product that only steps in to right, provide that downside protection and help them, right, continue to generate a certain level of revenue such that these companies can survive multiple commodity cycles. And hopefully as an industry, right, we'll do better over the long term. So I think that's one, right? Again, insurance price floors having sort of, especially when it comes to critical minerals, having certain inventories of these kinds of minerals and metals to alleviate the national security kind of challenges. And those are probably some of the examples that I'm sure it looks like Ian and Daniel have their hands up. So I'll pause and maybe let them chime in. But I think from an investor's perspective, we want that certainty, right? We want to make sure that these companies that we are investing in are going to be there and not go out of business when prices fall, because they will fall despite this amazing demand story we have.
Okay, Daniel, you were first. Do you want to?
I just think Tim brought up a very important point. I mean, not only in lithium, the name of the game today is maintaining and being a low-cost producer, right? So, in Brazil today, I mean, we are a very low-cost jurisdiction. And despite the fluctuation of the market, we've been able to keep up with our production, with having healthy operations, given that. And I think validation of that was very recently, we've seen some of our Australian counterparts investing in the region, given it's such a low-cost jurisdiction. So yeah, thanks for raising that point.
And Ian?
Yeah, I was just thinking of your specific question on what can localities do if they're not going to offer some sort of price support. And, I guess, as we mentioned before, right, so the program at Colorado School of Mines and Mineral Economics that Jonah and I are a part of, right, a lot of our alum are at places like Resource Capital Funds, where Tim was. But, when you hear them talk, there's a lot of discussion is back to something that both Tim and Thomas have brought up, is just this certainty. So there's lots of discussion that I've heard from the RCF folk, or the folk who are trying to permit new mines, saying, look, we're just not even going to bother, say with a place like the United States, because it's just too hard to do. And so, sure, like, I get that resource quality matters, and I'm not saying that it's not. But if we're going to get to this question of what could localities or national governments do to help, they can't do anything about geology, right? That's fixed. But they can do something about, hey, like, is that process clear? Does it look like we can get there? All those kind of other aspects of the permitting regime. I've heard a number of investors talk about, like, they just kind of need some certainty there. And then again, that's something that the localities or the national governments have under their purview to make decisions on.
That's super interesting. I feel like de-risking projects and countries as much as possible via both fiscal and non-fiscal methods is paramount to help bring the operations down the mining value chain. In terms of specifically trying to realize mineral wealth, Thomas, you had something to add before I ask the next question.
If we have time to prolong this discussion, because I'm quite interested with what Ian was saying and reading on them and Daniel.
No, of course.
Because I do talk to a lot of governments, in developing countries. Some of them don't have a long track record in mining, but they're now opening up because they want to take part in these, demonstratory and critical minerals. But so they're not able to. They want to provide this kind of certainty on permitting and be seen as a jurisdiction that's favorable to investments, but they don't have a track record. So how could they present themselves to investor in a way that show that they're serious about this and that they're going to provide certainty in terms of the permitting system? In the past, what we saw in a lot of mining agreements was a very basic, stabilization provision just to freeze legal terms for the whole duration of a project, and that hasn't worked in practice, especially when done in jurisdictions that don't have a mature legal system. They do have to update their laws at some point, and then they run into conflict with companies. So how else could they provide this kind of certainty without having their decades of experience in mining to show for it?
Yeah, if I may, I mean, I'm from Mongolia, right? So Mongolia is going through this incredible learning sort of a journey right now, as they're going through this exact sort of a case you just brought up, right, Thomas? they're trying different sort of things, right? Initially, they were really like liberal and then gave licenses out to everybody, and then people really hated that, and then all of a sudden that was closed down because people thought, they were giving the country away for free, for instance, right? That's just one sort of a view. And then these kinds of efforts sort of paid a dividend in having many companies sort of do really well. And then the government got greedy and said, okay, well, going forward, we're going to actually require significant, and strategic projects to give up carried interest to the government. And I'm talking pretty significant equity stakes for the government. Well, that basically stopped the foreign direct investment into the country. That's a policy that effectively failed. And then what they've then said was, okay, well, instead of doing this, we're only going to focus on taxes, royalties, and see if we can, invite people. But they're still, navigating that. And I think there are different things that they are trying and learning. And I think one of the things that countries can do is really try to build the ecosystem first before they can try to really capitalize on these companies. And really demonstrate that these countries are serious about inviting investors to partner with them and co-develop these projects, because ultimately these projects require billions of dollars to build and take in these emerging economies probably much faster, but still 5 to 10 years to get them online. And as you're doing that, you're going through these commodity cycles, right? So I think having a very investor-friendly policy is probably the right way to start. But once you build a very robust ecosystem, and as these governments learn how to partner with the commercial or the private sector, they can then hopefully use some of the proceeds to play in the sector themselves. So really appreciate you bringing that perspective, Thomas, of emerging economies.
So partnerships are important, especially, or can be important, especially when trying to sort of show your investor friendliness. But then how can we ensure, what mechanisms or measures are in place to ensure that sometimes the knowledge transfer happens to the producing countries to ensure that they can now do the sort of refining stage by themselves, for example? Do we know of any sort of measures that say this has to happen, or is this often something that doesn't happen? And how can we stop that from being the case?
Anybody else wants to jump in and provide their views, please do. I don't know if my views are the most appropriate one here, but I think ultimately, it's a race for economic development. I think the global South, especially countries like Mongolia, have this incredible advantage because they do have the resources and they do have existing knowledge base to tap into some of these really interesting critical minerals that are going to be developed and used in building many of the clean energy technologies that we're needing in the global north, if you will. And I think having a very good understanding of their strengths and weaknesses, and then being very sort of upfront with that, if you go to Mongolia, for instance, they have an incredible amount of, at this point, knowledge base, and they know how to build these mines. They know how to process ore and produce concentrates and sell them on the global market, But they haven't really yet, at least, leveraged technology to be able to tap into other sort of commodities outside of copper, for instance. But I think they can certainly do that. And having a sort of an open door policy to invite innovators, early stage startups to come in and say, hey, please come, take a look at all the sort of the projects we have, all the operations we have, What do you have to offer to help us produce more of our copper, more of our rare earth elements, or whatever that may be, And trying those kinds of things, I think, would be really helpful and not just, countries like Mongolia, but others to start, giving them that little bit of an exposure and edge and being, part of the broader energy transition story.
Innovation is key. But you raised an interesting point about early stage miners, and it can be argued that some mining companies have various barriers to overcome when they're looking for investment. But then I also think there's sort of like a subsection of that, the fact that it's often harder for junior miners to access the same sort of investment as sort of larger diversified miners. Is there any sort of insight that you could give us on that, Tim, please?
Yeah, I think there are a lot of technical challenges, right? It's not so easy to make new discoveries anymore, right? Like all the easy stuff have been found and have been mined, right? So because of that, many of these early stage exploration companies, who are looking for the next Oyu Tolgoi, right? They're having to look much, much, much harder, right? And the odds are against them. And because of that, investors aren't rewarding them, right? They're not investing in these companies to go out and then drill, 5 holes in the middle of the Gobi Desert, right? Because they know that they're going to be unsuccessful, right? If you look at the broader sort of the data set. But what could do is right, okay, well, if the traditional and incumbent techniques and methods are no longer working anymore, well, what are the other sort of different ways and techniques that we can leverage to right, make sense of the data that we have in the mining industry, make sense of the geology, right, much more efficiently and quickly, so that the little dollar that you raise as a junior explorer can actually put into the ground in a much smarter way. Right, and I think that's why you're seeing this resurgence or this emergence of innovation coming into the mining industry and asking all these tough questions, and then saying, okay, if we have limited budget, well, then let's actually try to allocate that into a completely different approach, so that we might be able to find something that could completely change the industry. Because if you're just going to be doing the same thing over and over again that the industry has been doing over the past 20, 30 years, right? Not a lot has changed, frankly. And I think the one thing that is getting constantly changing is that it's getting harder to be a miner or an explorer, right? Unless you really, really leverage something else, such as technology.
That's super helpful context. Thank you, Tim. So, Thomas, yeah.
Yes, if I can add, sorry, on the question.
Oh, sorry, I thought your hand was
yeah, no,
left
I
from
realized I had
before.
it.
Sorry.
No worries. I realized I'm used to Teams where it lowers your hand. Yes, on the value addition piece, I think it's super important to have this discussion and for companies to have this in mind. I'm glad Tim is already thinking about suggestions, because now there's really an expectation from developing countries as now we want to go into value addition as often as possible in as many projects as possible. It's really on top of the agenda. I mean, the UN Secretary General had organized a panel this year with experts from all over the sector, and different countries were represented. And one of the major recommendations on the economic side was that countries should benefit from domestic value addition in their deposits of critical minerals. The United Nations Center for Trade and Development is making it a big part of its agenda. A lot of countries have it front and center. So I do think it's going to come up again and again. It's good for investors to have this as part of their development plans when possible, and when not possible, to also explain to governments why some deposits maybe are not viable. They're viable to be extracted, but they're not the right opportunities to find some form of domestic beneficiation. Maybe it's too small. Maybe the market for that specific commodity is not suitable. But I think they need some kind of answers to really to be satisfied with permitting otherwise for mines. Because the default assumption would be we want some local industrialization from these mines.
Thank you. And Ian, do you have something to add on to that?
Yeah, I understand this is not as big of a deal in Brazil, or Daniel, Pedro, correct me if I'm wrong, but one aspect from a producer country perspective for some value addition is maybe, for lack of a better word, harmonizing the small scale mining that's going to happen near where a large firm is coming in to invest. I'm certainly not an expert in small scale or artisanal mining, right? But obviously the general idea, the locals have some knowledge of what's there. And obviously if they see a large company in the area, they know that the ground nearby probably also has some of that mineral in there. And then of course, that is the local population trying to make a living or earn money related to the mine. And so to the effect that can be, we'll say, sometimes we'll say properly encouraged, for lack of a better word. There's obviously lots of concerns if these are done, I'll say, unsanctioned or not in a way that protects the health of the small scale miners. But again, if there's ways that could lead to more, we'll say, innovation or more of the value captured by the local community, because either they're going to go get lower grade product or they have the ability to sort of enter the market that they would not have had otherwise. Again, not something I think is specific to, or that happens in Brazil. My understanding it's larger, right? Peru, sub-Saharan Africa, places like that. I think Chile also does not have much of a concern with small scale miners doing things that they're not supposed to be doing, we'll say. But that's another way for, value creation within the sector that stays at the national or subnational level.
Thank you for that. I'm going to move on to some of the audience questions. But before we do, I just wanted to, tried to scribble down some of the the key points that have been discussed here today. I just wanted to leave on that before we go to the audience questions. So first, starting with demand is maybe slowing down, but the long-term outlook remains positive for critical minerals. Supporting sectors such as infrastructure, innovation, and sustainability are vital to help drive forward producing countries, particularly in the value addition stages. Political certainty is another must when it comes to trying to maximize the realization of critical minerals potential in a country. In terms of fiscal regimes, it can't be a blanket approach. Each country needs to take its own unique stance, making sure they focus on the long-term perspective, collaboration, and efficiency of the regime in place. And finally, it's important that the strengths and weaknesses of a certain country are fully understood when it comes to looking for investment, but also investing in a given producer country. So some of the points that I've noted down from that really interesting discussion. So thank you. But I'm just going to go, as I mentioned, to some of the questions in the chat. So first, we have one from Hannah saying, how are producer countries, especially in the global south, being supported to negotiate fair terms for the extraction and export of critical minerals? Are there safeguards or international frameworks in place to prevent exploitation and ensure that the benefits of this growing demand are equitably shared? Does anyone have a initial stance on that? Thomas, I see your hand is up. Ian, I see you're nodding, so I'll come to you after.
Yeah, it's a great question. There are lots of material available for countries. So that's a lot of the work that IGF does. So we do have, on a broad scale, beyond the pure economic terms, we have a mining policy framework that we produce at IGF. It's based on consultation with member countries, and it looks like the main 6 pillars of best practice in terms of regulating the sector, from the legal side to mine closure, tailings, environmental management, economic, financial benefit sharing, etc. And so what we do is we use it as we use this framework to assess countries against all these pillars and see where where there's need to maybe to improve some of the regulations or some of the policies to make sure that mining leads to sustainable development. So that's at the broad level. Then if you zoom in on more specific, economic terms, how to negotiate fair terms, you do have a number of benchmarks available. There's the OECD principles for OECD principles for durable extractive contracts. That's a good result. It's been developed by a multi-stakeholder process with like the kind of provisions that balanced contracts tend to have. Then for specific support in specific negotiations, typically, government should have, strong legal and economic teams, engineering teams, supporting them. Sometimes they hire private law firms in addition if they don't have in-house capacity. For, lower income countries that maybe don't have the budget, there's additional support that can be provided by, World Bank, or regional development banks and other organizations that have this kind of offer as well. So yeah, feel free to get in touch if you want to know more about this, some of these support.
Did anyone else have anything else to add before I move on to the next question? No? Okay. Another question from Asaf saying, on the topic of producer countries moving up the value chain, how do the opportunities in terms of scope, ease, market structure, so on and so forth, compare to those existing in the traditional metals or for oil producers? So I think saying if we focus more on the sort of like the newer lithium energy transition metal focused value chains, how can they compare to traditional metals or those seen in other commodities such as oil?
Again, at least give my understanding relative to oil, right, is that much less of the value chain is just getting it out of the ground for minerals or critical minerals than it is for oil. And so partially why there is this discussion of let's try to move further down the value chain, because the value chain does not really end just at pulling the raw product out of the ground.
So there's more complexity, it seems, in lots of these critical minerals value chains compared to more traditional commodities, say, which makes this task a whole lot harder.
Yeah, and the other thing that was commented on earlier, right, is just this idea that these are much smaller markets. So if we're thinking maybe about total value created, it's way smaller, say, compared to oil and natural gas or something like that. I think it was in Jonah's presentation. So you also have to understand that, you're not, right, you're not talking as much value.
And if I may, we often find many other investors who are quite sort of apprehensive in investing in companies or projects that are being developed in these like small markets that Ian just talked about, right? It's great to be an investor in the aluminum space or the iron ore space or copper because these are massive markets, quite fragmented. Right? Not a lot of like dominance by a certain country, but if you look at rare earth elements, for instance, right, it's massively dominated by one country. Or if you look at these very specific like minor industrial metals that are only used in defense, for instance, right, it makes it less attractive for countries and investors to play in those kinds of sectors, right? Because the markets are small, they're opaque. You only have one or two customers. Right, and then you're often the pricing is often dominated by other people who you have no control over in terms of whether your industry is going to survive or not. So because of that, investors are not investing in those kinds of as much as they should be, right? So and I think being mindful of those kinds of dynamics is absolutely necessary.
Perfect. Thank you both. There's one question specifically for Minas Gerais. So do we see an opportunity to process lithium in Minas Gerais? And if not, what are the key barriers to this?
Sure, I can start here.
Yes, please, Daniel.
Okay, sure. No, I mean, specifically in the conversion process from spodumene concentrate to the chemicals, Brazil has the industries that can absorb the residues from these processes, namely the cement industry and the cleaning materials industry. So yes, there is the opportunity there. There's a lot of interest from, at least that we've seen from the Brazilian Development Bank, as well as from the federal and state governments to move forward. I guess the challenge is just, coming up with, sustainable practices for this process. Pedro, I don't know if you'd like to compliment.
And like you said, I think our government project called Lithium Valley, one of the aims of it's to enable Minas Gerais to develop the entire lithium production chain. So we are focusing on investments, we're focusing on P&D, let's say like this, like development of research, so we can bring technologies here for Minas Gerais, attract investments in new technologies to develop the entire lithium production chain, not only the extraction of the mineral, but we want the battery here. I mean, I don't know, in a few years, we want the carbonate of lithium, for example. So it's something very big for us, and we are doing a massive job here to make this happen in the next few years.
Thank you. And just before I pass back to Paul, there was just one other question that was answered that I thought I'd share with the group. So Carlos asked about the role of small-scale miners in helping foster critical minerals productions, and Ian spoke about some of them earlier, but Carlos wanted to know if are there any other types of CRMs that are fostered in this way in other countries. Tem pointed out that there was fluorite miners and producers in Mongolia, and Ian said that there's also a few, the CRMs, the critical raw materials are there, even if they're not targeted for now. So there's potential for this method to be used to help foster production in the future. So with that, I want to thank the panelists for their time and pass back to Paul.
Thank you so much, Ellie, and to all of our panelists for this really excellent discussion. I think it has been incredibly illuminating, certainly for me, to get such a diversity of perspectives on some of the key challenges that we hope to be addressing in the new series and research initiative that we have just launched here at JFI. So we're so excited to continue to be in touch with all of you and to draw on your insights and perspectives as our work advances. So just for kind of one last chance to say thank you again for being part of our conversation, and really excited to keep the dialogue going. Thank you all very much.
Thank you.
Thanks, everyone.
Thank you, everyone.
Thank you so much.